Tax rate and tax base. The rate times the base equals the revenue. Now the tax base is whatever the law says is subject to the tax. And that seems to be a pretty simple formula, except for two issues. Do the rate and the base interact? They do. The rate can affect the base. It can rise or fall, as we just saw in the previous slide. So when the Joint Tax Committee puts on or estimates the revenue that you can get from raising the gasoline tax or raising the cigarette tax, they try to calculate how much the consumption of gasoline or the amount of smoking is going to go down when the tax goes up, and they take both the change in the base and the change in the rate into consideration. They generally don't do this if you're putting a tax on labor or capital. In the larger economy, they hold the economic forecast constant, so those base changes are not generally taken into account. That's called static scoring. And in dynamic scoring, which they attempted in analyzing the Camp bill, they did try to figure out what the literature was saying about what would happen to the size of the labor force and the rate of participation and the quantity of capital that might be formed under the new tax law. Now, economists are kind of all over the place on that, and they don't have any one completely tested model to point to, so they've tried a couple of different models, and they're still groping their way toward what might be achieved in some consensus manner. We have our own model where we think we can answer the question pretty well and pretty quickly, but the thing is, at least you're trying to figure out what happens to the base as well as the rate. Now, there's another situation. The base may not be what it seems. If you define something as taxable, and off we go, and the IRS writes a regulation, did they get it right? Did the base actually conform to something out there in the real world? And unfortunately, the answer is very frequently no, not quite. So two areas of concern. We have tax credits, exemptions, deductions. We have thresholds. We have phase-ins. We have phase-outs of various credits and benefit reporting requirements. How do they affect the tax base and the tax rate? And another problem, more broadly, what is it we're trying to tax? Production, which is income, or consumption, which is that portion of income that you actually consume and not reinvest. So we have to worry a bit about what is in the base and how the rate's affected.